Welcome to Money Depth Insights. I am the finance guide, John Nell. Today, we are talking about how real wealth is built without trying to predict the market, without chasing perfect entry points, and without relying on timing that feels intelligent but rarely works in real life. Most people approach investing with a quiet belief that success depends on being early, being fast, or being right at the exact moment. They watch charts, follow headlines, and wait for the right time to act. What often goes unspoken is that this approach does not fail because people are careless or uninformed. It fails because markets do not reward prediction nearly as much as they reward consistency, patience, and behavior over long periods of time. One of the first things experienced investors learn, usually through frustration, is that market timing feels logical but behaves unpredictably. Even when someone correctly predicts a downturn or a rally once, repeating that success consistently is extremely difficult. Markets move for thousands of reasons at once, many of which are invisible until after they have already happened. This is why timing often looks obvious in hindsight but feels uncertain in real time. What actually builds wealth is not the ability to guess what markets will do next, but the ability to stay invested through uncertainty without letting emotions dictate decisions. This is not a motivational idea. It is an observation drawn from decades of market behavior and real investor outcomes. One common mistake people make is waiting for certainty before investing. They want confirmation that the market is safe, stable, and moving upward. The problem is that by the time certainty appears, prices have often already adjusted. Markets price in expectations quickly, long before confidence feels comfortable. Waiting for clarity usually means paying a higher price later. Another mistake is reacting to volatility as if it were danger rather than normal movement. Market fluctuations feel alarming because they are visible and frequent. But volatility is not a signal that something is broken. It is the cost of participation. Long-term growth does not happen in a straight line, and attempts to avoid every downturn often result in missing recoveries that matter far more than the declines themselves. People who build wealth without timing the market accept that uncertainty is permanent. Instead of trying to eliminate uncertainty, they design their behavior around it. They invest regularly, regardless of headlines, and allow time to absorb short-term fluctuations. This approach removes the pressure to be right and replaces it with the discipline to remain consistent. A powerful example of this is systematic investing. Investing a fixed amount at regular intervals removes emotion from the process. It prevents hesitation during downturns and overconfidence during rallies. Over time, this method naturally averages out market highs and lows, without requiring prediction or analysis. What looks simple on the surface becomes powerful through repetition and duration. Another overlooked factor is the role of compounding. Compounding rewards time far more than precision. Starting earlier, even with smaller amounts, often leads to better outcomes than starting later with larger sums. This is not because early investors are smarter, but because time allows growth to build on itself. Interrupting that process to time the market breaks the compounding cycle and reduces its long-term effect. Many people also underestimate how damaging inactivity can be. Sitting in cash while waiting for the right moment feels safe, but it quietly exposes wealth to inflation and opportunity cost. The market does not need to collapse for waiting to be costly. Even modest growth missed over years compounds into significant differences later. Behavior matters more than strategy in this context. The most successful long-term investors are not those with the most complex models, but those with the simplest plans they can actually follow. They decide in advance how much to invest, how often to invest, and under what conditions they will change course. Then they follow that plan with restraint, even when emotions suggest otherwise. A common behavioral trap is overreacting to news. Financial news is designed to capture attention, not to support long-term decision-making. Headlines exaggerate urgency and uncertainty, which triggers emotional responses. Investors who check markets constantly often feel compelled to act, even when no action is necessary. Long-term wealth builders limit their exposure to noise and focus on fundamentals instead. Another important insight is that market timing assumes mistakes can be corrected quickly. In reality, mistiming often requires two correct decisions, not one. You must exit at the right time and re-enter at the right time. Getting one wrong can erase the benefit of the other. This is why even skilled professionals struggle with timing consistently, despite having far more data and resources than individual investors. Diversification also plays a role in reducing the urge to time the market. When investments are spread across assets, sectors, or regions, short-term movements feel less threatening. This stability makes it easier to stay invested during uncertainty. Diversification does not eliminate risk, but it smooths the experience enough to support better behavior. It is also important to understand that wealth is built gradually, not dramatically. Sudden gains capture attention, but steady progress builds outcomes. People who focus on dramatic wins often become impatient with normal growth. That impatience leads to unnecessary changes, which increase the chance of mistakes. Experienced investors often describe their success as boring. Not because it lacks meaning, but because it lacks drama. They make fewer decisions, not more. They avoid constant adjustments. They allow time and discipline to do most of the work. This boredom is not accidental. It is protective. Building wealth without timing the market also requires redefining what success looks like. Instead of asking whether an investment outperformed last year, long-term thinkers ask whether they followed their plan. Process becomes more important than outcome. When the process is sound, outcomes tend to follow over time. Another practical observation is that emotions do not disappear with experience. Even seasoned investors feel fear during downturns and optimism during rallies. The difference is not emotional absence, but emotional management. They acknowledge feelings without allowing them to dictate behavior. This skill develops through structure, not willpower. One of the most effective structures is having a long-term purpose for invested money. When money is clearly assigned to future goals, short-term market movement feels less relevant. Purpose creates patience. Without purpose, every fluctuation feels personal. People who successfully avoid market timing also accept that they will never buy at the lowest point or sell at the highest point. They stop chasing perfection. Instead, they aim for participation. Being invested through most of the market's growth matters far more than capturing every peak or avoiding every dip. Over time, this mindset creates confidence that is calm rather than reactive. Decisions feel less urgent. Mistakes feel manageable. Progress feels steady. Wealth grows quietly, without constant attention. Ultimately, building wealth without timing the market is about aligning behavior with how markets actually work, not how we wish they worked. Markets reward patience, consistency, and resilience. They punish overconfidence, impatience, and emotional decision-making. When you stop trying to outsmart the market and start working with it, investing becomes less stressful and more effective. You stop reacting to every movement and start trusting the process you have built. If this perspective helped you see investing more clearly, share your thoughts in the comments. And if you believe this understanding can help someone in your colleague or friend circle, make sure to share it with them. Education grows when knowledge is shared. This video is created for educational purposes only. For more calm, practical, and long-term financial understanding, subscribe to Money Depth Insights. I am the Finance Guide, John Nell, and I will see you in the next session.